Hey traders, today we'll be going over exactly how to use the MACD indicator as well as an effective MACD trading strategy. Let's get into it. The MACD, which stands for Moving Average Convergence Divergence, is a very popular momentum indicator used by traders all over the world. At first, it might look a bit complicated until you begin to understand what the different components of this indicator do. So let's set it up on our charts and we can run through this step by step. To add the MACD to your chart, click on Indicators at the top of the screen and search for MACD, and then click on the first search result. This will add a copy of the MACD indicator below our chart. After that, you can double click anywhere on the indicator to open up the settings window. So on this window, the only thing we're going to change is the thickness of the lines. So click on the MACD line, and then at the bottom, increase the thickness by 1. And then click on the signal line and do the exact same thing. Now, switching over to the Inputs tab, we're going to be leaving the fast length at 12, the slow length at 26, and the signal smoothing at 9. If you followed along, then your MACD indicator should look something like this. So the first component of this indicator is the MACD line itself, which is in blue. Some traders think that this line is simply just a moving average, but this is not true. The MACD line is the result of a calculation between two different moving averages. So if you're using the default settings for this indicator, then this line will be calculated by subtracting a 26-period exponential moving average from a 12-period exponential moving average. The second component of the MACD is called the signal line, which is in orange. It's calculated by taking a 9-period exponential moving average of the MACD line itself. Or to put it more simply, it's taking an average of the last 9 values of the MACD line. This results in the signal line being a slightly slower, more smoothed out version of the MACD line. And you can see this quite clearly in the chart. When price drops on our chart, the MACD line responds fairly quickly to this drop, whereas the signal line responds to it slower. And when price rises on our chart, the MACD line also rises shortly after, whereas the signal line is slower to follow along. You'll also notice that there are times where the MACD line looks kind of jagged, where it changes direction multiple times quickly. But this won't happen with the signal line since it's a smoother version of the MACD line. The final component of the MACD indicator is what's called the histogram. These are the red and green bars you see in the middle of the indicator. Now this may look kind of complicated, but you'll see in a second that this part of the indicator is actually incredibly simple. The purpose of the histogram is to plot the difference between the blue MACD line and the orange signal line. The periods when the MACD line is above the signal line will result in a positive value for the histogram, so we will see these green bars forming. Whereas when the MACD line is below the signal line, this will result in a negative value for the histogram, so we see these red bars forming. But why is it that at some points the bars on the histogram are much larger than at other points? This is because the histogram plots the difference between the MACD line and the signal line. So the further away these two lines are from each other, the bigger the bars on the histogram will be. So when the lines are very far apart from each other, you will see these large bars forming on the histogram. And you'll notice during the times when the lines are very close together and are kind of zigzagging back and forth over one another, you'll see these very small bars forming on the histogram due to the fact that there is hardly any space between the MACD line and the signal line. Okay, let's get into the trading strategy. So the way that most people say to use this indicator is to wait for the MACD line to cross over the signal line and then enter a trade in that direction. But from what I've found, this is not reliable enough for a standalone entry signal. You'll often see periods where the MACD line and signal line cross over one another many times back and forth. If you took an entry every time they crossed each other, then you would quickly lose many trades in a row. So I prefer to combine the MACD with another form of market analysis and use the crossover of the lines as an entry signal only after I've already established a strong trade premise. So the first step of this strategy is going to be to identify a higher time frame level of support and resistance. So here we are on a 4-hour chart of the dollar Canadian. We have a level at the very bottom of the chart that acted as support twice. We have another level above that one which acted as support 3 times and also as resistance 3 times. We have another level above that that acted as resistance 3 times and also recently acted as support. But the level we're going to be focusing on for this particular trade is this level right here. When price reached this level for the very first time, we saw a strong rejection to the upside where buyers stepped in. The second time price reaches this level, buyers step in again and we see a smaller rejection to the upside. Eventually, when price accepted below this level, we saw one final pullback into it. This is the point where sellers stepped in and started a larger downtrend. So now that we have this level drawn in, let's switch over to the 5-minute chart and move on to step 2 of this strategy. So here we are on a 5-minute chart of the dollar Canadian. Here is our level that we took from the 4-hour chart. So now that we've established a trade premise from the higher time frame, we can use the MACD on the lower time frame to help us find an entry opportunity for this trade. So we have a period of low momentum on the left, where price is moving mostly sideways. The MACD and signal line begin to come together and the bars on our histogram become much smaller. We then see a push up from price and then a pause. You can see that during this period of time, the MACD line and signal line cross over with each other 1, 2, 3, 4 times. If you had taken an entry every single time they crossed over, then you would have had 4 losing trades in a row. This is why it's so important to have a strong premise for your trade before using the MACD to find an entry. We see a final push up from price into the 4-hour level of resistance, and the green bars on our histogram begin to get bigger as the MACD line and signal line begin to separate. Eventually, we see the MACD line cross over with the signal line here after price has rejected the 4-hour level. This would be our signal to enter a sell trade, so we would enter on the corresponding candle right here. We then see bearish momentum come into the market as the red bars on our histogram begin to grow larger. Now there are 2 ways that you can choose for your trade management on this style of trade. The first is to simply wait for a crossover of the MACD line back above the signal line before closing your sell trade. In this example, the crossover happens here, so you would close your trade on the corresponding candle. So while some traders prefer to do it this way, I find it can often take you out of a winning trade too early and will result in leaving a lot of profit on the table. So the way that I prefer to do it is to instead identify a level of support or resistance and close your trade when price reaches that level. So in this example, we see a clear level on the charts here where we saw multiple reactions from price earlier on. So we would draw that level in and wait for price to reach it before closing the trade. Alternatively, if you prefer setting multiple profit targets for your trades, then you would zoom out and identify multiple levels of support or resistance and close a portion of your trade each time price reaches a level.